Back to within 1% of all-time highs. 30 minutes ago onto the start of your equity trade, I'm Dani Burger.
And why would you be surprised, Dani? I'm Bonnie Quinn. Open Interest starts right now.
Coming up on the show, Wall Street's winning streak continues. Morgan Stanley delivers another record quarter.
Tech stocks advance as ASML offers fresh proof the AI boom is still going strong.
And we've got yet another tame inflation reading. Producer prices cool again as Fed Chair Warsh returns to Capitol Hill.
All right, let's take a look at some of those stocks to watch. Just mentioned it, ASML driving broader tech stocks higher after an earnings beat and raise. It also plans to boost production to meet demand. It essentially gave us an outlook right as far as 2028, Dani.
So that's driving tech stocks. And to everybody else, congratulations, you survived all of the bank earnings. You did it, and it was rounded out by Morgan Stanley this morning. They reported record stock trading revenue alongside all the other big banks. They say that the deal-making pipelines are full. We also heard from asset manager BlackRock. Total assets are now above $15 trillion. For the first time as industry-wide earnings top estimates. The animal spirits in financials are alive and well, Bonnie.
Well, let's get more on that, Dani. Indeed, from Bloomberg Intelligence financials analyst Neil Sipes. Neil, Morgan Stanley, the final one, bringing us to a close, really, for this earnings season, at least for the big brokerages. What about this $148 billion in net new assets in wealth management? What did they do to attract all of that money?
Yeah, so that's a meaningful number. And I think especially when we look at Morgan Stanley going after all of the larger banks yesterday, the wealth management franchise is the bread and butter of Morgan Stanley. They've been building that out for, over a decade now. And I think you're seeing some of the fruits of that sort of integrated wealth model that's attached to the institutional franchise, the capital markets unit that has been producing the eye-popping numbers that we've seen so far this earnings season. And when you look at that $148 billion in net new assets, that's about 8% organic growth. So that's pretty good within, the wealth complex. But interestingly, this quarter and something that people have been focused on is, with these sizable private companies coming public, there's a lot of wealth tied up in that with the employees there. And so about half of those flows actually came from IPOs in the second quarter. Presumably a lot of that from SpaceX. And so with more mega IPOs on the horizon, whether it's in the second half or pushes into 27, it seems like that sort of flywheel of institutional and wealth can sort of propel this franchise.
It's remarkable to look at the equity trading. Also based off that, the results of having SpaceX come in, it's a perfect storm because not only that, just the size of SpaceX caused a lot of managers to rebalance, which creates more equity market volatility. Equity market volatility already alive and well because of AI. Those specific conditions, is that repeatable or even beatable for these big banks? Yeah,
I think that's where we stand today is the question of, okay, is this repeatable or is this a one-off quarter? I think that remains to be seen. I mean, there's nothing on the near-term horizon that suggests markets just shut off and turn dim. But that is sort of the idea around the trading businesses and why analysts and investors tend to assign lower multiples to that revenue is because, okay, the second quarter was incredible. We had multi-billion-dollar beats in numbers that we haven't seen either ever or in a decade plus for the equities franchise. So what does the second half bring? What we can see on the investment bank side is, pipelines are full. Goldman Sachs posted the best investment banking fee quarter since 2021, which was a record when they reported yesterday. But they also said the banking backlog is at a 5-year high and increased sequentially. So despite all the conversion, despite all the fees and IPOs that came through, the second half looks potentially even better.
And Morgan Stanley shares are down now, but we saw the same with Goldman and JP Morgan, that they maybe wobbled in the pre-market and ended up, at least in the case of Goldman, much higher. It wasn't the same for Citi. And I wonder if there's some read-through between both Morgan Stanley and Citi. Morgan Stanley reported higher expenses than expected. And Citi especially is talking about this idea that they're going to lay off more people and make more investments into their business. And that's going to cost more. Is that enough to spook this market, just hearing of higher expenses despite other parts of the business being extremely strong?
Yeah, and I think that's the tough position where you are today, where I think a lot of that capital markets windfall that we're talking about today and sort of expecting in the second half, some of that may sort of fund the investments going forward, which of course brings into question operating leverage and how much that actually flows into earnings. So, obviously Citigroup has a longer-term transformation that they're undergoing right now. Whereas for some of those capital markets-oriented franchises, I mean, you look at Goldman Sachs, you look at Morgan Stanley today, I mean, significant compensation ratio relief. So effectively, the revenue windfall from the capital markets business that's firing is flowing to earnings, and that's what you typically want to see from an investor base. Obviously, lots of ideas swirling around AI. Most of them have framed it as a productivity increase and sort of maybe absorbed through hiring rather than slashing heads and replacing humans with robots. That doesn't seem the base case today.
At least if they are, they don't want to talk about it because it's
right.
Bad PR. Neil, thank you so much for joining. Really great to have you on. Neil Sipes of Bloomberg Intelligence. Elsewhere in this market, tech stocks are leading the broader market higher today. ASML, which is key in the AI pipeline, reporting an earnings beat and raised its forecast. Bloomberg Tech's Ed Ludlow joins us in San Francisco. And Ed, maybe today's a good case study for SK Hynix of how it helps to have ADRs trading, because the ADRs of ASML are doing extremely well in the pre-market too. Some of these companies, even when they beat earnings, it's been disappointment. Samsung among them. Just how strong were ASML that despite a 75% rally year to date, we can still get a nudge higher on strong earnings?
Strong short-term and long-term. And SK Hynix is linked in there as well because Korea is a really important end market for ASML. There's a lot of focus on the raise and beat, right? I think now sales for the year, 43 to 45 billion euros. What's happening behind that is not just that they are seeing demand accelerate on a longer time horizon. They talk about customers, both on the logic side, compute and memory, placing longer term agreements for the latest chip making equipment, but also they're servicing existing customers. The installed base is upgrading its technology, it's servicing its technology. Why did SK Hynix sell the ADRs? In part, they're going to buy ASML machines. So that's a big part of it. I would say look at the sell side summary. The analysts are very focused on how big a signal ASML's capital expenditure growth is, its commitment to improve capacity or boost capacity. But that certainly would seem to have cleared a high bar in the context of this year's performance.
Ed, what do you think about the Reuters report that Stripe and Advent are teaming up to buy PayPal? I mean, there's a lot of detail in this report, and PayPal is up 18%, so there's something going on out there.
I've been thinking about it a lot, Vonnie. I try to think at this time in the morning. I mean, we reported in February, right, that Stripe had expressed interest in part or all of PayPal. $60.50 a share in what's really interesting, by the way, in the context of deals, like Stripe, as Reuters reported, coming with private equity in Advent and saying, this is the premium, 28% to Tuesday's closing price, with no intention of breaking it up. And, a lot of people have seen logic in the idea for Stripe. Stripe is a juggernaut, but PayPal just has the consumer wallet. So it instantly gives you access to a different market and makes Stripe a more holistic financial services platform. Merchant, peer-to-peer through Venmo if they go ahead with this, right through to checkout. So it's an interesting one. I think we wait for a response, right, from PayPal's board. They have a new CEO at PayPal. They're trying to cut costs. What's really interesting, again, the analysts look at this and say, it's probably a sign that PayPal shares have been a little bit undervalued, and that, whether this goes through or not, there's a lot of opportunity in future for PayPal.
And you'd have to wonder about regulatory concerns as well. I'm sure we'll be revisiting this soon. Ed, thank you so much. That is Bloomberg Tech's Ed Ludlow. We also have our eye on the healthcare sector this morning. Johnson & Johnson shares dipping just a little bit after the company reported revenue for its MedTech segment that fell short of expectations. The firm also posting mixed sales for its drugs. Joining us with more is Bloomberg's Madison Muller. What's the read across, Madison? Is this purely a J&J story? Is it a consumer story? Why the maybe slight underperformance?
Yeah, thank you for having me on. I mean, J&J is interesting because it is a really diversified company. The company has both drugs, they also have med tech devices, they make surgical tools, and typically that can be a boon for them. But when one of the units misses, like we saw today, came in a little bit below expectations on the med tech side, that can hurt their shares and hurt the sentiment among investors. So one of the reasons that their med tech business is coming in a bit below expectations is because of this company, Abiomed, that they acquired, and they make devices like heart pumps and things like that. And there have been some recalls there. There was also a recent study that didn't do as well as people had hoped, and that sort of hurt demand as well. So what we're seeing right now is pretty isolated to J&J, but J&J is typically one of the first pharmaceutical companies to report earnings, and so it can be a little bit of a bellwether for the rest of the sector, although as of right now, it seems like this is maybe a bit isolated to a J&J situation.
We did see some maybe of the smaller healthcare players report earnings. Yesterday, Madison, the whole entire sector took a slump after HCA reported earnings, and they're talking about people losing their access to insurance via Obamacare. What exactly is happening there?
Yeah, so there were some changes and some shifting payment trends earlier this year, and that prompted millions of people to drop coverage this year. There are even more changes looming with cuts and new eligibility rules for Medicaid taking effect next year. And so that's something that could also affect this sector, as we're seeing that could have come into play a bit with J&J as people potentially delay surgical procedures as they're unable to afford them. So that's something to definitely continue watching in this sector over the next year or so.
All right, Madison, thank you very much. Bloomberg's Madison Muller, the latest on healthcare. A check on your equity market this morning. We got fuel from yesterday's CPI report that put us within striking distance, less than 1% away from all-time highs. We gained this morning. It's being led by tech, up 0.5% for the NASDAQ versus the S&P's 0.25% gain, thanks to strong earnings out of the Netherlands, ASML, helping to carry us further. 10-year yields, those continue to come in. We saw a huge rally yesterday after CPI that was somewhat muted post-testimony from Kevin Warsh when he continues the Fed chair to talk about commitment to taming inflation. Brent crude still higher, though under $86 a barrel, Vani.
Let's get a look at some individual movers on our radar now, Dani. BNY Mellon profit beating estimates as revenue hit a record due to higher fees.
Meanwhile, some other bank earnings. PNC topped second quarter profit estimates. Higher net interest income and fee revenue helped offset a rise in credit costs.
Intel shares higher after ASML said that Intel had begun to use its most advanced machine for chip production, up more than 2% now.
Coming up, we talk more about inflation, another key gauge coming in tamer ahead of Fed Chair Warsh's Senate testimony. We're going to take a look at PPI numbers. That's coming up next. This is Bloomberg Open Interest.
Now to high interest now, a look at what's making headlines around the world. The US launched more airstrikes on Iran today, with President Trump pledging to intensify the bombardment until Tehran stops attacking ships in the Strait of Hormuz and agrees to open the waterway. Meanwhile, Iran insists the Strait will remain closed until American attacks and the naval blockade end. The House has passed the Sunshine Protection Act, which would make daylight savings time permanent and end the twice-yearly clock changes. The bill passed 308 to 117, now heads to the Senate. Supporters cite brighter evenings and safety benefits, while critics say the permanent standard time is healthier. Over 400 CLO deals could see ratings upgrades after Fitch Ratings and Moody's proposed methodology changes. Now, the firms say they're updating outdated assumptions. Critics, though, warn the changes could revive pre-2008 concerns about ratings competition, while supporters say they better reflect how CLOs have performed. Dani.
Let's get more on the inflation data that was out this morning. Producer prices rose less than expected in June, suggesting the fallout from the Iran war remains somewhat contained. It also comes alongside Fed Chair Kevin Warsh returning to Capitol Hill today. Joining us now is Stuart Paul of Bloomberg Economics. 2 days in a row, softer readings when it comes to inflation. How much comfort can you take in these figures?
Well, it's at least favorable for the June PCE reading. That's really what I'm looking at the PPI report for. We get a lot of the inputs to the PCE from today's PPI report. And what we really saw is a major downside surprise in portfolio management fees. That's one of the major swing factors every month that goes into the core PCE. And it matters a lot for fine-tuning that PCE reading. Also, a lot of medical care services that feed from the PPI into the PCE came in pretty tame. One factor that is nudging up core PPI services that caught my attention was the margins charged by fuel retailers, right? Of course, you have the cost of fuel itself, but the margin that is collected by fuel retailers is an indication of the value of the service that's being provided by those retailers to firms, and so that counts as a separate category. About half of the monthly increase in core PPI services is that margin being collected by retailers. And now what that matters is that the president has been really attentive to gasoline prices, because gasoline prices have not come down from where we saw commensurate with peak oil prices. That margin is creating a buffer. It's creating a little bit of a dislocation between what we see in retail fuel prices and global energy prices. And so the volatility that we're seeing in global energy prices is being buffered. It's being a little bit dislocated from what we're seeing at the retail level. And so just as we're seeing an uptick in global energy prices over the last couple of days with escalation in the Middle East, we probably will not see a commensurate increase, because that margin is creating a buffer. It's creating a little bit of a loose joint.
Why not, though? I mean, the margin goes up when the prices go up. So two questions. A, are we going to see this become a problem, or is it just too small in the PPI to, rear its head? And B, could the president go after the retailers as opposed to big oil?
It's interesting. So that margin widens when you have increased volatility and uncertainty in the outlook. And so while we have seen a little bit of additional escalation over the last several days, I'll say even major escalation over the last several days, even global energy prices have not risen in line with what we would expect with, let's say, the extent of the bombing campaign. So even global energy prices are not as reactive. That margin is not going to be widening as much as, let's say, we saw in March and April, given the fact that everybody is more fine-tuning their expectations for the outcome of the war and ultimately the flow of energy through the Strait.
So we also had Kevin Warsh speak yesterday. The data originally led us to our biggest decline in 2-year yields since May. 10-year yields, they somewhat cap some of that decline. They still decline after Kevin Warsh basically says CPI data doesn't mean that we have reached mission accomplished. What do you make of that? Because he's someone that has been more reserved in commenting off data directly. Yet he gave us that nugget of information yesterday.
Yeah, so I think that Kevin Warsh has a few different jobs that he needs to accomplish in his 2 days of testimony. First, yesterday before the House Financial Services Committee, and today before the Senate Banking Committee. That first job is that he has to at least assert his independence from the administration. He has to appear to be willing to take on a president who has been advocating for lower interest rates. By asserting his independence, he's going to sound incrementally more hawkish. The second item, and it's related, is that by being a little bit incrementally more hawkish, he gets to talk down the long end of the curve, which is really what matters both for the federal government and ultimately for consumers, who a lot of their financing costs are tied to rates further out of the curve, not the Fed's policy rate. And that's really what I think he was trying to do. In addition to buying a little bit of time, the CPI buys him some time to build a coalition on the FOMC.
Well,
and
he said that would be
decision.
his ideal scenario, right? Bring down longer end rates, and that help the housing market as well, which is really the only way the Fed can do that. Stuart, thank you so much. Stuart Poll of Bloomberg Economics. Coming up, Victoria Fernandez talks about the signs she's watching for a peak in this bull market. This is Bloomberg Open Interest.
Strategists looking for signs that the bull rally is near the top. Crossmark's Victoria Fernandez says if profit margins are peaking, we would anticipate the labor market to begin to show cracks 6 to 12 months out. Keep an eye on consumption if earnings start to disappoint lofty expectations. Let's bring in Victoria. Victoria Fernandez, Crossmark Chief Market Strategist. And Victoria, you put it really well. Expectations are incredibly high, something like an upgrade of 20% on earnings year over year. Do you think that bar, is it troubling to you, or is this one that you think corporate America can easily meet?
It's troubling in the sense that we don't know how long we're going to be able to meet these types of expectations. So can we meet it this quarter? Probably yes. We know we have really strong profit margins. Revenue growth is strong. So it seems like we would be able to meet the numbers that are out there. The concern is this the peak? Is this as good as it gets for us? And it's downhill from here. And if so, then I think we're setting ourselves up for some disappointment. We'll have to see the market start to consolidate or pull back if earnings can't continue the levels that we're expecting.
Victoria, you say a market top is typically associated with, financials underperforming, credit spreads widening, money leaving the market, right? Credit spreads are not widening and financials didn't underperform. So is that proof enough that we haven't hit peak yet?
Well, at least it tells us that for right now, the market is pretty confident and we have these strong tailwinds. So you're right. When we look at credit spreads are about where they were a year ago. They've tightened in from earlier this year. So that's a support for the economy. We actually have some decent liquidity in the market right now. That's supportive of the economy. And you're right. When we look at money in this market, at a market top, money tends to leave and go to the sidelines. We're not seeing that. The conversation, as you guys know, over the last few weeks has been all about the rotation. So people are still wanting to be invested. They're still putting money to work. This tells us the tailwinds are there for now. But again, it's looking forward over the next few quarters. Are we going to continue to see that? Or do investors start to get really concerned that the profit margins are not going to stay where they are?
I was listening on Surveillance. They had on with them the Wells Fargo head of equity capital markets, and she made a really interesting point that one of the risks for year ends is just the fact that this year has been so strong. And given all the volatility and uncertainty, maybe you just have more people taking profits and less willing to participate in this market. Is that a risk, Victoria?
It is a risk, Dani, and I don't think that's necessarily a bad thing. I mean, we tell our clients all the time, when we've made, really good profits on a certain name, we feel like it's gotten maybe a little bit overbought. There's nothing wrong taking a bow, trimming some positions, taking that money and putting it to work somewhere else. And I think we could see people start to do that, especially as we get more and more concerned around CapEx. Obviously, IBM yesterday made a lot of people concerned around, are we going to see that CapEx? I think the phrase they used was reprioritization, going more to hardware than to software. We could start to see some profit taking, and that would be supportive again of the rotation as long as people see positive earnings and profit growth going forward.
All right, Victoria, you're going to stick around with us through the opening bell. Victoria Fernandez, as stocks rally, again, just minutes to go until your cash trade. Seconds until we start your trading day. This is Bloomberg Open Interest. I'm Dani Burger. And it might not feel like it, but we're not too far away from all-time highs. We just need to gain less than 1% to get there. We're up 0.25%, not quite there at this moment. The Nasdaq outperforming. That is up 0.5%. Some good earnings in the Netherlands for ASML, helping to revive some of the AI trade, though some of the chip stocks are selling off again. The Dow, that is up 0.2%. Down at the New York Stock Exchange, we have the hosting committee for the New York, New Jersey FIFA World Cup tournament. Do not try to contact me at 3 p.m. I will be rooting on England. Don't give me your bullish predictions on Argentina. I don't want to hear it until after that game is over. Okay, maybe more importantly, Mike, I'm just going to ask you if you can come in and just zoom in on these adorable faces. I'm going to step out. You don't want to see me. You want to see these adorable little doggos down at the Nasdaq. This is the North Shore Animal League America. They are apparently the largest no-kill rescue shelter in all the United States, and that is important. And I don't know why they're at the Nasdaq, but I'm so happy they are because it's so cute. I love it. Okay, back to these markets. ASML, again, that's driving some of this tech trade higher. It's up by nearly 2% in the U.S. trade for their ADRs, and earnings beat and raised. It also plans to boost production to meet demand. Again, the chip makers selling off, Vonnie, this morning. SanDisk down 3%. It might just be because, I don't know, they had a good day yesterday, and it's a ping-pong narrative, and they move not necessarily on any news these days.
Yeah, I mean, SK Hynix itself, the ADRs were up 27% yesterday, Dani, so I think there's a lot of churn going on in this market. Meanwhile, Morgan Stanley reporting record stock trading revenue and a huge inflow of assets for its wealth management business. BlackRock total assets are above $15 trillion for the first time as industry-wide earnings top estimates.
Let's bring in Crossmark Chief Market Strategist Victoria Fernandez. And Victoria, let's start on those bank earnings. Incredibly strong. The reaction wasn't even across the board, but for most of them, huge gains like Goldman Sachs posting in not just record trading when it came to their equities business, but also its best day in terms of the trading of the stock itself since we had Liberation Day. What do you take away from these bank earnings? Is it something to give you cheer, or is it something that looks less repeatable, just given SpaceX's IPO and the market volatility they were able to capitalize off of?
Well, we do know, Dani, that the IPOs gave a lot of lift to them, especially when you look at Morgan Stanley and at Goldman. I think the numbers for Morgan Stanley was 148 billion in new assets coming in that were tied to the SpaceX IPO. So I'm not sure we can repeat with those same types of numbers, but I do think it supports the idea that financials are doing better. They're in that uptrend. They're continuing to produce new highs. We had 50% of the banks in the sector yesterday in the S&P finance sector actually hit 3-month highs. So there is a trend there, and I think it's an area we're investing in, and I think it's an area that you can look at going forward to maybe rotate some of those funds out of tech into the financials for the coming months.
It's interesting though, Victoria, isn't it, that at a time when we've seen record volumes, we are now seeing actually pretty low volume. Have people started to step away from their desks for the rest of the summer, or what exactly is going on?
Maybe so. Maybe they're all going to the game today like Dani wants to do, right? I don't know. Maybe World Cup is getting people moving around. And it is the end of the summer. You do start to see some thinning in trading as we come, and you start to see seasonalities change as you go into the end of July and the beginning of August. So there is an element of that that's coming to fruition here. But I also think you're looking at new escalation in the U.S.-Iran war. You're looking at an earnings season. And so people might be sitting a little bit here and waiting to make their moves until they get earnings numbers or until they get better clarity as what things are going to look like in terms of energy and commodities.
You've also noted, Victoria, that much of this earnings season rests on the shoulders of the consumer. We haven't gone full force into consumer earnings yet. We maybe got a sneak from Pepsi last week, and it wasn't fantastic. I wonder, is that very specific to consumer staples and discretionary, or is it enough to upset this overall equity market, just given at the moment gains have been incredibly narrow surrounding AI-related companies?
Yeah, I don't think it's just the consumer sector that we have to worry about, because it's a much broader issue. The concern around the consumer is going to come from the fact that if we do see profit margins start to weaken, if we do see layoffs start to pick up, then that's going to affect consumers and all of their spending, right? Not just that discretionary spending, but across the board. So I do think consumers right now are supporting a lot of what we're seeing in the economy. Obviously, they've had boost from the One Big Beautiful Bill, from tax refunds. They've been spending down their savings, but that can't continue to go on for very long. So we have to be mindful of what it looks like, especially when consumption is growing faster than incomes. And obviously, World Cup and Prime Day probably helped those numbers over the last few weeks. I can say I was part of the Prime Day buying frenzy that there was, but I do think going forward, we might see that pull back, and that's going to be a concern across the board.
Victoria, what was the fallout from the SpaceX IPO? Will we see Anthropic and OpenAI delay their IPOs because of this? Or, I mean, are conditions so good that why would you delay?
You know, Lonnie, it's true. We have seen, I think, already some narrative around those getting pushed further out. We were expecting them to be, I think, before September, and now it looks maybe they might be later in the year or even going into 2027. I do think there might be a little bit of hesitancy, and some of that related to cost of capital that we're seeing, yields moving higher, more concern on the geopolitical side. So perhaps there's some other reasons that are feeding into having a delay, but I would expect them to come to market over the next 6 months or so. And I would expect them to be oversubscribed, just like we've seen on SpaceX.
How is that still the case, Victoria, with just the amount of supply that's come to market, be it SpaceX, some of these other IPOs, a cross-listing, the biggest ever from a foreign company in the way of SK Hynix? I know a really big bullish thesis for not just the equity market, but credit markets too. It's just there's a lot of money on the sidelines that needs to get put to work. Is there a level, or is it just so far away at which there's enough supply that starts to tip that supply-demand balance?
Look, demand is there. I mean, it doesn't matter, it seems like, what's coming to market. The demand is there and it's soaking it up. Even if you see it in the credit markets, like you mentioned, we've seen a lot of the hyperscalers come to the credit markets. Those are oversubscribed. We see it in the SpaceX IPO, and SK Hynix, like you mentioned. There does not seem to be a lack of demand from investors that are wanting to put money to work. And I know there was a lot of discussion around maybe that's part of the rotation trade that we saw, people getting money to have kind of arrows in their quiver for these elements that are coming into the market. But it seems like, you know, investors are ready to put money to work in these areas. They see long-term growth potential there, and they're not worried about balance sheets as of yet. That could become an issue further on as we see free cash flow continue to decline in some of these big tech names. But for right now, investors are game and ready to go.
Victoria, so wonderful to have you on. Thank you so much for joining. That's Victoria Fernandez of Crossmark. About 8 minutes into your trading day, let's get a check on your equity markets. And again, we rise higher. We need to get to, I think it's 76.09 or thereabouts was the last record. So we need to surpass that in order to hit another record. We're not too far away. We're gaining about 0.5% so far this morning. What is leading us there? It is Mag 7 in the big cap tech. Apple, Amazon, Microsoft, Broadcom, Tesla, Alphabet, all leading the charge. Bank stocks continue to rally with JP Morgan and Bank of America. One of the interesting things, Vonnie and I were talking about this, the fact that chip makers are declining today and a lot of the memory stocks. It feels like this trade that you can't have both the Mag 7 and the chip makers gaining in the same day. One of them is up, the other one's going to be down, and that's still the case today with Micron and SanDisk leading the declines in terms of points moved to the S&P. A really bad day for healthcare too. Eli Lilly is down. Elevance Health is down because J&J had pretty poor earnings. I don't see J&J on the biggest decliners list, interestingly enough, but it is bringing down all of healthcare with it. And if you look at the sectors, healthcare is the worst performing. That safety stock index, or now it's energy, actually. It was healthcare just a moment ago. But both of them are pretty evenly tied, down about 1/3 of 1%. And then at the top, you have consumer discretionary, communication services with the big Mag 7. And again, financials having a very strong day yet again, Vonnie.
Yeah, we didn't get quite the bump from the PPI that we got from the CPI, that's for sure, Dani.
Yep, already priced in.
Yeah, exactly. Coming up, Goldman's global co-head of capital solutions shares his outlook following a blockbuster quarter for the bank. This is Bloomberg Open Interest. All right, let's get a little check on markets now. As you can see, we are higher on all of the major averages, but not by as much as we were earlier. That PPI boost not holding, right? So we got the CPI yesterday and markets really rallied. And today, just a little bit more trepidation. I would say as well, the ASML call is about to start. And so investors have actually erased gains in ASML. They had been higher earlier after we got basically a 3-year outlook for those chips. But as you can see, all of the major averages are higher. Time now for top calls. Some of the analyst action in focus this morning. First up, Oppenheimer is cutting IBM in the wake of its negative pre-announcement that spurred an historic sell-off in the stock. The firm says the miss makes it harder for IBM to hit its full-year outlook or deliver on double-digit growth. Still higher, though. Next up, Allstate is getting downgraded at UBS. The firm says Allstate's underwriting margins are likely to deteriorate over the next 6 months, and that would lead to declining earnings and a higher risk of earnings misses. And finally, Raymond James downgrading Checkpoint Software, saying the cybersecurity company's comeback is taking longer than expected. The firm points to slowing demand and a weak second half sales pipeline. And that's interesting because the cybersecurity firms actually had a nice little bump off the IBM CEO's comments yesterday, Dani.
Let's get back to bank earnings, though. And Goldman Sachs delivered a blockbuster second quarter with debt underwriting hitting a fresh record. Equity underwriting more than doubled. I spoke with Mahesh Sairedi, who runs the business that oversees all of that. He is global co-head of the Capital Solutions Group at Goldman Sachs. I asked him about those results.
If you take a step back and look at what's driving this, right? There's 3 different themes that are driving this. The first one really is what's happening with AI and CapEx globally, right? It's again, the numbers keep going up every day, but let's call it like 7 to 9 trillion of CapEx that has to happen into AI over the next 3 to 5 years. Theme number 1. Second theme is what's happening with our merger franchise. You look at M&A activity, year to date, we are already at 3 trillion, probably end up with another record in terms of total M&A volume. And then the third thing is the private capital that keeps coming into the market, right? So we have about 14 to 15 trillion of AUM sitting with the private capital. So if you combine all of this, it kind of plays right into our debt and equity businesses because all these things need capital, and we are sitting right in the middle of all of this. So to your specific question, I do feel that the momentum that we have, the tailwinds we have from all of these, I think are going to keep markets pretty active for the second half for sure.
Kind of a new baseline, would you say? This is the new normal, just considering all the trends you're talking about?
Now, obviously, as with everything, right, it will never be a straight line, right? So as we're just talking about, the markets always will have some volatility, right? So we will see these phases, but if I take like a longer horizon and look at kind of these themes that are there, I think these themes are here to persist. I don't think these themes are going to go away anytime soon. So I would think of this as like we're in a market where everything is bigger and there's going to be more activity.
Let's pick through some of those themes, and starting with AI, because the amount of supply that has come to market for AI has been quite remarkable, and you've kind of been at the forefront of all of them, whether it be SpaceX, whether it be SK Hynix. On the debt side, we've also had huge issuings too. I think Amazon alone has offered about $100 billion so far this year in debt markets. What happens when that much supply comes to market and it continues at pace, considering you have a lot of the same capital competing for it?
Yeah, so let's look at some of the data, right? Like, this year to date, there's already about 1.4 trillion in IG issuance in the US. 20% of that is something related to AI. But I think the more important thing, Dani, there is this year alone, there's 10 deals that got done, which are 20 plus billion. And to contextualize that, over the last 7 years, that number is about 11. So we are seeing a lot more deals which are much larger in size. And even with all of that, now again, obviously spreads widened out a little bit over the past week, especially, right? Like the IG universe overall still is largely unchanged, whereas the hyperscaler spreads are widening probably at around 30 basis points over the last week. So I think the supply absorption capacity is there. I think it's just a question of like what is the pricing at which it gets absorbed. That might change depending on kind of where we are in the cycle and asset allocation. But big picture, though, we feel there is a lot of capital that's available to kind of fund these things. So, but we will have gyrations in the market. That's pretty normal for any.
How do you distinguish between a gyration and what we're seeing now with the spreads widening versus saying, okay, this is a market that has become more discerning. It's not just going to buy every debt. It's not going to buy every single equity offering that comes to market. Is this a market that's getting more selective?
Yeah, I would say there's a stat that we spend a lot of time looking at, which is kind of the single name equity wall versus index wall. So if you look at kind of like, so index is kind of a representation of what the market thinks about broadly how is the economy going to evolve. So index wall is actually as low as it's been. Whereas single name wall is the difference between single name and index wall is as high it's been. So that goes exactly to the point that you're making, which is markets are very discerning about each and every name. Like pricing a single name actually is a much more of a premium right now because we're in a very uncertain world. We're in a world where the impact of AI and how it's going to evolve is very uncertain. So there is going to be name by name analysis that has to get done.
Do you think that makes more companies who have yet to come to market? I'm thinking of an OpenAI. I know there's some rumors about Samsung doing an ADR. They've since denied that. But do you think it makes companies more hesitant to come to market than maybe they were in the first half, just given the volatility that we've seen erupt?
I think what we really find is like the companies which have a good underlying story, especially again, anything around AI theme, I think there is still so much appetite from the market that I don't think this is going to change anything. Now, again, the timing might be different. If some macro thing changes, that could kind of postpone some of the things. But bigger picture, though, I do think this momentum that's there in the AI theme, that would mean more of the companies will be tapping both equity and debt markets.
Well, let's go to private capital, where I know you spent a large chunk of your time as well.
Of course.
Private capital has seen this backlog. Your colleague David Solomon was talking about it on the earnings call, basically saying that, yes, M&A markets are really robust, but we have seen sponsor activity lag below its 10-year averages. What brings back private capital and private equity specifically? Yeah,
so if you kind of, again, private capital itself obviously is a much larger space. If you break it down between private equity and private credit, we can come back to private credit, but private equity is really where there's been a little bit of a jam, right? If you look at the numbers again, there is about 4 trillion of assets that have to kind of get disposed of by private equity. But the stat that I'm very focused on is the average time it takes for an asset to get disposed. And that's at 7 years right now. And that's an all-time high, right? So, and the other stat that we spend a lot of time thinking about is the return of capital, which is what LPs are very focused on. And that's kind of been around the 10 to 12% range over the last 3 years versus averages of 16 to 17. So I think there is some work to be done there. The kind of the software hiccup that has happened is not helping that too. So private equity overall, I do think will have a little bit more time before kind of it gets back to its normal run rate in terms of capital return, etc. But having said that, I think one of the things that all of us tend to do is when these trends emerge, we tend to kind of, go in two different directions of like, oh, is this the end of, what's happening with private equity? And in a world where if you look at the overall equity capitalization, it's about 150 trillion now, globally, right? So that needs private capital. So on a 3 to 5 year horizon basis, I think this backlog will get cleaned up.
But does the backlog get cleaned up by capitulation? That's something Scott Kleinman of Apollo has said. Do you think that's what these funds are going to need to do to clear it up?
I think it will be a combination of things. Again, we are seeing that obviously in terms of like valuation discounts that companies are comfortable taking versus historical. So there will be some valuation reset for sure. I mean, some companies will obviously benefit from the AI tailwind and they'll probably perform well. And some will actually come to the public markets, but I think it's going to take some time.
That was Mahesh Saireddy of Goldman Sachs off the back of record earnings from Goldman Sachs. Coming up on the show, Palantir Chief Technology Officer joins us to discuss the future of defense technology right after this break. You're watching Open Interest. Let's head to the U.S. Army War College, where defense and technology leaders are gathering this week to discuss the future of America's defense industrial base. Bloomberg Washington correspondent Tyler Kendall is there with Palantir's Chief Technology Officer. Tyler.
Hey, Dani, thanks so much. As you mentioned, I'm pleased to say I'm joined now by the Chief Technology Officer of Palantir, Shyam Sankar. Shyam, it's so nice to see you here on a day where we are talking about bolstering the U.S. defense industrial base, made perhaps even more urgent by the fact that we are seeing the conflict in Iran. The Pentagon keeps asking defense tech to move faster. Can you give us a status update on what the relationship is right now between innovative companies and the Pentagon and what hurdles still remain?
Well, I don't want to sound too Pollyannish, but I really think this team at the Pentagon has dismantled almost every hurdle that exists and has sent a clear signal that they want to hear about the remaining hurdles that people do confront. They've sent a clear message that this team should meet the urgency of the moment here. And while we can look at the conflict in Iran and look at the rate at which we're expending munitions, really this is a challenge that's grown over the last 30 or 40 years of how we've managed and thought about our defense industrial base.
I'm not sure if everyone would agree with the fact that the Pentagon has dismantled the hurdles. What about when it comes to defense spending, for example? I'm curious how you're tracking that. The Trump administration has requested $1.5 trillion, seeming to indicate that there is a big need from the administration's view to help bolster our own capabilities, including when it comes to replenishing our stockpiles.
Well, I think it's going to be very clear that we need both more of our existing exquisite weapons and we need capital to invest in a whole new class of weapons to meet the asymmetry of the moment here. And the side that moves faster is going to win. And our exquisite weapons are amazing, but most of them we really built in the 80s. And they've been designed in a way that meets the manufacturing of the 80s. And we're starting to see enormous success with a whole new generation of weapon systems. We look at the Saronics kinetic strikes in Iran just a couple days ago. We look at the success that these new platforms are happening in conflicts in Ukraine. We need to be moving capital there. If you look at the 27 budget, there's a huge amount of resource that's made available to these autonomous systems and to AI, which really, I'd say the Pentagon has actually been one of the fastest places to adopt AI in the American economy. Given the stakes, they're existential, it's a binary win-lose. Nonetheless, they've done all of that by essentially cobbling together budgets from various line items. 27 will be the first time they put a real stake in the ground, real capital that's committed to accelerate the pace-setting projects that will drive us to an entire revolution in how we fight.
So part of this is about keeping the U.S. competitive, and we saw the other week the French government actually decide to end its relationship with Palantir, in part because of a need to bolster their own domestic capabilities. And we're seeing this play out among some other European allies. Talk about this concern about being too reliant on U.S. tech. Are you concerned at all about Palantir losing a foothold in Europe, or that this could expand to other international markets that you're part of?
The product really stands for itself. I think serious people, the Germans have looked at it, they've examined the software, they know there's no backdoors in it. There's a huge part of this that really comes down to almost an economic argument of we really want to spend our money on our own companies, and I don't begrudge them that. I think the kind of vicious, underhanded campaign of lies and rumors is probably beyond the line of what's fair there. But every country should make a decision based on what's going to give them the most amount of deterrence. And clearly the U.S. has carried the load there. We have the most experience, the most reps, the most innovation stimulus here. And I think it's going to take an entire allied Western force to really confront the challenges across the axis of authoritarianism that's clearly present and creating chaos in the world.
Well, I'll keep on the international theme, if you will, because we're seeing U.S. companies start to use Chinese open source LLMs. From your view, does this pose national security risks?
Well, I think it poses, my view is that national security is not an end unto itself. It's a means to an end. And the actual end is American prosperity. And so I think it poses a threat to American prosperity. These Chinese open source models are really the result of distillation attacks. Most of this is just stolen American IP from Frontier Labs. And I think the Frontier Labs should do more to protect that IP, and that's in their own economic interest. But I'm less worried about it in the present moment because the gravest threat to us is not homicide, it's suicide. It's an inability to turn these tokens into economic value and generate American prosperity for it. You see that with the proposed moratorium in New York on data centers. Like, turning our back on AI would be as consequential a mistake as turning our back on the atom in the 70s. And we're starting to see a burgeoning, it's just the beginning, but a burgeoning US open model ecosystem forming. NVIDIA's Nemotron models are very good. I think you're going to see in the next month a slate of announcements of other American companies, non-frontier labs, sometimes called neo labs, who are putting out open weight models that companies are going to be able to cheaply fine-tune and capture their own alpha in weights they control.
In the final minute that I have you, part of the U.S.'s strategy when it comes to national security has been to have the government take equity stakes in companies that are deemed critical to national security. We know the idea has been floated when it comes to some of these frontier labs. I'm wondering what you make of this strategy. Is this the right way for the U.S. to go about it?
Well, I think it's very case dependent. I'm glad it's an option on the table. I think for some companies where they need a huge equity injection, it could make a lot of sense. For other companies, based on where they are in the mix of business they do between the commercial and government world, I'm not sure it makes as much sense. But I'm glad it's an option that's on the table. It should be a consideration.
All right, Shyam Sankar, the Palantir Chief Technology Officer, thank you so much for joining us here on Bloomberg Television and Radio. This has been a conversation on the sidelines of the Defense Summit here in Pennsylvania, and I'll toss it back to you.
All right, Tyler Kendall, thank you so much. That was Tyler Kendall there with Palantir's CTO. Just want to point out that we erased all of our gains in the NASDAQ 100, but we've actually just put on a couple of points again, so we're still in the green, barely. We are much, much higher, though, when it comes to the S&P 500 and the Dow Jones Industrial Average. We're not far off our records, essentially. And when you look at Brent, we're just below $85 a barrel, so we had that big $10 move, Dani, and we're sticking around here for now, no matter what, it seems, the president says.
At the moment, awaiting another testimony from Fed Chair Warsh yesterday. He spoke CPI, even though the numbers were softer, it did not suggest mission accomplished. That was enough to curtail at least some of the rally in yields yesterday. But again, we're moving to the downside once more. The data this morning, PPI also looking softer, giving some breathing room to Kevin Warsh as we await that testimony as he participates in front of a Senate panel this time. Joining us is KPMG Chief Economist Diane Swonk. Diane, I would just love to hear what you make of Kevin Warsh yesterday. It is a Fed chair who's tried not to tip it or show his hand very much in how he's going to be reacting to the data, but he did give us somewhat of a clue saying the CPI does not suggest mission accomplished.
Well, and that's absolutely right. And I think, even though he wants to get away from forward guidance, the bottom line is right now inflation appears to be the larger concern for the Fed. We're 5 years in and we still have inflation. It's not all of the Federal Reserve's fault. There's a lot of reasons. We got close to a soft landing. But at the end of the day, the Federal Reserve is the only institution that is charged with derailing inflation. And it's become too much of a problem for too many. And I think that's where we are right now. It is no longer price price stability as Greenspan once defined it, which Kevin Warsh has said he has his admiration for, and that is that prices no longer factor in, are front of mind when you're walking down the grocery store aisles or in any store and how you're making your decisions. You want prices to be out at the front of your mind, not making trade-offs every day, where the majority of U.S. consumers are feeling those trade-offs in every financial decision they make.
Diane, was there something troubling about the PPI data today? I mean, you know, on the face of it, it looks benign. It was better than expected, and yet the market does seem to be reacting somewhat negatively.
Actually, the components that feed into the PCE are not quite as good as those for the CPI, and so that actually suggests a higher level of inflation than the CPI, and this is, of course, the Fed's targeted index. So those components suggest that there's still lingering inflation, most importantly, in core services inflation. That has been the stickiest out there, and it looks like from this data that goes into that we're still going to see a very sticky number in the month of June as well for that data. And that's, you know, of course, is the end of the Fed meeting in July. So I think that's very important to remember, is that we're still seeing stickiness in inflation where it's been the most worrisome and where it was worrisome prior to the Strait of Hormuz being closed in late February, early March. And that's really important because this data was starting to come out and confirm to the Fed the battle that they thought they had won in terms of inflation was not won prior to the increases in energy prices. The increases in energy prices now amplify that. And of course, as we stand today, with tensions still flaring in the Strait of Hormuz and the war ongoing, that means additional price hikes from energy prices, adding to that muscle memory that we're starting to develop, something that the Fed is charged to get rid of in the overall economy, is exactly that muscle memory.
Even so, Brent is still well below its peak of this year. I mean, we went months above $100 a barrel, and we're struggling now to even get back above $86 a barrel. The market, too, Diane, didn't react until we got something closer to $110 a barrel. So is this a market that's more immune to oil prices that we're seeing at this moment? What does it actually take to get you concerned that energy is resurging and will have follow-through effects through higher inflation, through ancillary measures?
Well, actually, I'm very concerned about the lags implicit in the global food stock. It's already hitting emerging Asia, and a lot of that flies underneath the radar screen, where actual rice can't be harvested because of the high cost of diesel prices and of rationing in emerging markets. That doesn't hit us as much initially, but the global food stocks are going to be hit by the higher prices of fertilizer and higher prices of diesel and reduced crop yields. Then you throw into that an El Nino this year, which is further complicating global food stocks. And that feeds right into 2027 as well. We get the spring harvest season. The planting for that starts in September and October. And so you're going to get still higher prices if this is not resolved by then, which does not seem likely, that you're going to see some kind of elevated increases in those input costs spill into that as well. And why is that so important? Because food is one of the most salient prices. It's up there with the price of gasoline. We strip it out to look at the core to see what underlying prices are doing. But prices at the grocery store really matter to consumers, and they set consumer expectations, much like prices at the pump.
Diane, how concerned are you about this most recent escalation? I mean, 4 straight days now of strikes on Iran. Iran is not doing anything to reopen the Strait. The US seems to be just getting in deeper and deeper. And if we have more of a spike, won't it be worse this time, given that SPRs were being drawn down and tanks were already close to bottom?
Well, you know, for me, this is not my decision to make, but I can tell you the economic effects are real. They're affecting low and middle income households much more than higher income households. And in an economy where higher income households do more, a huge heavy lifting, and inequality is so high, that masks that underlying pain that I think is very important. And I talk to a lot of retailers across the economic spectrum, and except for the extreme luxury the ultra wealthy are spending with abandon, there is a a huge amount of strain out there. You're seeing even higher income households move downstream to get better deals and stretch their dollars more, going into discount stores, off-price retailers. That's all very important because it's symptoms of an underlying fragility in the economy. We've been remarkably resilient in the economic aggregates carried by the AI boom and the wealth it generates. And part of the resilience in the equity markets has been due to that AI boom. Some sort of fragility on the sides that I'm worried about, it being a little frothy. I also worry about, I have a lot to worry about these days. A lot doesn't let me sleep at night. But I think it's important to think about how many foreign buyers are coming into the equity market now. They're not buying bonds as much, but they are buying U.S. equities to be part of that AI boom. And that's helping to buoy prices through what normally would have been even minor corrections that might be healthy. And I think that's the things that we have to sort of take into context here is we don't know the actual straw that breaks a camel's back. I still have a resilient economy in 2026, but at what price? And the price, even though the inflation data has cooled, it's not cool enough to be back of mind and price stability to be anywhere near right now where we're standing. It's a very unstable global economic environment.
For those just joining us, we are awaiting a testimony from Kevin Warsh down at the Senate Banking Hearing Committee. We're currently looking at Tim Scott, the senator from South Carolina, giving opening remarks, the Senate Banking Committee chairman. Diane, it sounds like you, again, doesn't sound like you say, that you're worried about quite a few things. And I wonder to what degree can some of those things be solved by a rate hike? It's a market that completely backed out of pricing for this month to get a rate hike. We're still pricing one in by year end. Is that necessary from this Federal Reserve?
I actually think 2 rate hikes are necessary by the Federal Reserve. The structural factors, it's unfortunate that we've got a lot of supply shocks that are pushing up inflation. We've had repeated ones in addition to demand over the last 5 years. You pick a day, you can have a different set of factors, but all of them lead to the same path, and that's a persistent period of elevated inflation. And we know post-pandemic, a period of uncertainty, which I argue today has gone from episodic in the past where you'd have a storm, the damage passed, we all did the repairs and it was over and you could move forward, to being endemic uncertainty where you're constantly weighing on big investment decisions that's causing a hesitation out there. All of that is adding to the inflation environment. We know in an inflation environment where you have a lot of supply shocks with high levels of uncertainty gives you more persistent bouts of inflation. That's what the post-pandemic period and the research has now told us. That's a job, sadly, only the Federal Reserve can fix. And inflation is the most regressive of all taxes out there. It hits those who can afford it least the hardest, and that's why the Fed has to raise rates. It is hard because those people who are affected the least by inflation are also affected the least by higher interest rates.
Yeah, exactly. But Diane, I mean, if there's one thing we know, it's that this Fed under Kevin Warsh is on inflation, right? He's said it so many times. Inflation is a choice. He's, a conservative economist. He doesn't want inflation past 2%, et cetera, et cetera. What if we also start to see the unemployment rate tick up and those same households that are suffering from years of inflation start to lose jobs?
Well, that is the challenge, and the lessons of the 1970s were every time that we stopped in the wake of a supply shock, we ended up trying to stimulate to get employment better. We ended up with a stagflationary cycle. So you don't want to let that occur. That is much worse than what we have today. That said, I would argue the 1970s are very different from today in so many ways, and one of the most important is inequality. Income inequalities hit a bottom in 1980 from the post-World II period, and ever since then, with a brief period in the 1990s, those inequalities have widened. Wealth inequality was very little in 1980, and that's because we had no equity market gains in the 1970s. Yeah. That is not the case today. And so the inequality means that the pain of the 1970s that we saw was an ugly, horrible decade of my childhood. It has defined me as an economist. It haunts me to this day, what I saw growing up in the Detroit area. And it's part of a sort of an arc that has brought us to where we are. That said, the pain back then was shared. We understood it I understood when my best friend went into poverty and my family did not. I understood that because I saw it firsthand. I think that's important that that pain is not shared today as well. And that puts even more urgency, I believe, on the Fed to deal with this inflation and eradicate the inflation we have, because it is so corrosive. And I don't take it lightly. I'm a cancer survivor, but if you let inflation go, it can metastasize. And it is like a cancer. It is corrosive and can get in your system. And that is not what we can afford right now.
Diane, just so incredibly impressed, not only by your brilliance, but by your resilience to life lessons that are so important for all of us to hear. Diane, thank you so much for joining us. That is Diane Swonk of KPMG. At the moment, we are hearing from Senator Elizabeth Warren as she gears up to ask, and many expect, a grilling of questions to Fed Chair Kevin Warsh. Let's listen in as they head to the testimony of the current Fed chair.
Across the board. Inflation has kept real wages from growing for the third consecutive month. That means in the Trump economy, families are falling behind with less to spend every day that goes by. High interest rates are making mortgages, auto loans, and credit cards more expensive. More and more people are falling behind on their bills. 95% of Americans believe that the U.S. is suffering an affordability crisis, while President Trump continues to call affordability a hoax, telling Americans their concerns about the cost of living are made up. Lower interest rates would provide some relief to families, but the Fed hasn't lowered interest rates and may be forced to raise rates even more, all because of one man, President Trump. Now, the president knows this, so instead of changing course, he wants to take over the Fed. Installing you as Fed chair was a critical part of his plan. You reportedly told the president exactly what he wanted to hear in your Oval Office interview, and Trump confirmed it afterwards, saying, quote, Warsh thinks you have to lower interest rates. Now, for your part, you were the only member of the last Fed meeting who declined to submit economic projections that are supposed to show how the Fed's decisions under your leadership are likely to affect American consumers and American workers. People might look at that and conclude that you don't want to tell the truth about inflation under Trump. Trump may have you in his pocket, but he will not stop until he controls the Fed. And he just needs one more seat to do that. And that's why he has had his Department of Justice open bogus criminal investigations into both Governor Lisa Cook and former Chair Jerome Powell. And that is why he illegally tried to fire Fed Governor Cook. His own Supreme Court recently blocked the firing, at least for now, but Trump has vowed to try again to fire Governor Cook. The fight for control is a fight over interest rates, but it is also about corruption. President Trump likes to play king, and the Fed offers many appealing opportunities for the president to enrich himself while he fleeces the American people. Start with crypto. Trump's family crypto company is World Liberty Financial, the centerpiece of the crypto enterprise that let him rake in $1.4 billion in 2025 alone. Now it is currently applying for a bank charter. After that charter is granted by Trump's own bank regulator, World Liberty could seek special privileges from the Federal Reserve to juice its own profits, like a master account that would give Trump's own company direct access to the Fed's core payment rails. And there's more. If he can control the Fed, Trump could threaten to revoke banks' access to Fed services if they refuse to do his bidding. He could hijack the Fed's extraordinary powers to bail out financial markets, making sure that he rewards his friends and punishes his enemies in a crisis. And you better bet that Trump will turbocharge the Wall Street deregulation that is already underway. juicing mega bank profits and CEO bonuses, knowing that American taxpayers will be on the hook once again if there's another devastating financial crash. Congress and the American people will be watching closely whether you serve the public or whether you become yet another instrument of Donald Trump's corruption. Thank you, Mr. Chairman.
Thank you, ma'am. Chairman Warsh, thank you for being with us. The floor is yours. 5 minutes.
Thank you very much, Mr. Chairman, Ranking Member Warren, other members of the committee, good morning. It's a privilege to join you. It's my first appearance before this panel as chairman, and I'm particularly honored to represent my superb colleagues from across the Federal Reserve System. In submitting the monetary policy report, I can't help but think of a long line of central bank chiefs who came before the Congress in keeping with the Federal Reserve Act, and I can't help but think of the best of the Fed's traditions. As a country, we just marked our 250th year. And when Americans count our blessings, we can include an economy predicated on the brilliance of our constitutional design and system of ordered liberty, an economy without equal in all it's done for human flourishing. Some forms of communication, including some that the ranking member referenced, are discretionary, but not this one, and for good reason. It's a prudent and wisely conceived obligation designed to keep the Fed responsible, accountable, and faithful to the mandate that you gave us of full employment and price stability. These obligations are of a piece with the Fed's rightful independence in the conduct of monetary policy. Today, we're at a hinge point in history, and it's up to each of us, myself included, to meet this moment. The Fed's #1 objective is to get monetary policy right. That's our clear and constant aim, the star by which we steer by. And if we get policy right, and we will, the inflation surge of the last 5 years will be a thing of the past. Just a month ago, I chaired my very first FOMC meeting. My colleagues and I recognize that high inflation has been an undue burden on American households and businesses. And while monthly fluctuations are inevitable, especially in an unsettled world, underlying inflation over longer-term horizons is determined largely by monetary policy. As I've said before and will say today, inflation is a choice. The members of our committee have no tolerance for persistently elevated inflation, and we share a resolute commitment to restore price stability. That was our focus when we met a month ago, at which we decided to hold the target range in the federal funds rate at 3.5 to 3.75%. Naturally, our work at the Fed demands a proper reading of economic conditions. As you might have seen in our report, economic activity is expanding at a solid pace, showing resilience in the face of recent developments. Household consumption growth is moderate, and manufacturing output has moved up steadily this year. The housing sector, however, strikes a different note. It gives a different picture and continues to lag. I want to highlight the most striking feature of our economy right now, and it's business investment. It is a surge in capital expenditures. Compare that to what we've seen for a long, long period of financial engineering. This is a better situation. The rapid pace of CapEx, which appears to be accelerating, reflects in large part the construction of infrastructure, including in and around AI and the immense demand for AI-related equipment and software. Investment in equipment overall increased about 8% for the year in the first quarter. Within that category, high-tech spending logged an especially impressive growth rate of about 25%. We don't yet know the extent to which the economy will benefit from this build-out. Yet it seems inevitable, at least to me, that what is now called AI investment will soon just be called investment. Even so, new opportunities for the economy introduce new challenges for policymakers. We at the Fed are monitoring the implications for the inflation and for the labor market. That brings me to the supply side of the economy, a subject worthy of equal attention, where productivity growth has been strong. And I'll note that this productivity growth predates gains from AI adoption. America's labor force appears to be broadly stable. Job creation has kept pace with the workforce. The unemployment rate low and has changed little, quite frankly, over the last year. We're seeing relatively few layoffs and only slight variance in the rate of job vacancies. Solid growth in nominal wages, too. I've been heartened by the welcome I've received and by the encouragement of my colleagues. We have a duty to point the institution forward, to take a fresh look at current practices, to make sure we're serving our objectives, and we're going about it systematically. As the chairman referenced, I appointed a task force in each of 5 areas that are central to the conduct of monetary policy. I'll just reference them and close. First, Fed communications. Second, our balance sheet policy. Third, our use of existing data. Fourth, productivity and jobs. And finally, the Fed's inflation framework. Our purpose here is to make better decisions in the conduct of monetary policy and put these years of high inflation behind us. We are the Federal Reserve, Mr. Chairman, and as determined as ever to fulfill our mission. Thank you, and I welcome your questions.
Thank you, Chairman. Each member will have 5 minutes to ask questions and get answers, and I'll start that off. And I'll start off with your working groups. I think credibility equals transparency. And the names that I've seen on your working groups, from Doug McMillion, former CEO of Walmart, to Mark Andreessen on productivity and AI, tells me that you're serious about getting real-world experience and expertise involved in making decisions at the Fed. I want to give you just a minute of my time to walk us through perhaps 1 or 2 pieces of that, as we talked about the importance of having contrast on the committee, on the working groups. Really important from my perspective. I think it lends itself to having more confidence in the Federal Reserve. I want to give you a minute to talk about one part of it, and then I want to move quickly to AI.
All right, let me be brief, Mr. Chairman, but you're highlighting something that's awfully important. All institutions, including the Federal Reserve, which I am so proud to lead, filled with great people, on occasion, we need to bring new ideas to the fore. And after 63 months of inflation above the Fed's target, it struck me that any new leader should arrive at this organization and look to the very best minds that we could find. There's a lot of great ones at the Fed, but there's a lot of great ones that aren't even in the economics profession. And I reached out to 15 people who I have known and trusted with a diversity of views to see whether they would take the most important questions that are going to be the determinants of monetary policy and the determinants of the economy in the next 5 years and see if they could sharpen their pencils and do their best work. It's a move towards transparency and new ideas. I'll just give one example before turning it back to you. In the last couple of days, we've gotten data on consumer price index, today on the producer price index. Any central bank would be happy to have the data going in the right direction. My view is these are all imperfect measures of the state of underlying inflation. So one of the task force is going to see whether we can do better, have better data from external sources, and even better ideas as to how important organizations like the Bureau of Labor Statistics, the Bureau of Economic Affairs, might think about how they could do a better job in an evolving economy.
Thank you. We met just a few weeks ago with Dr. Phelan, who's slated to be the head of the president's economic advisors, and we talked a lot about artificial intelligence and the impact it will have on our economy, and whether or not it will destroy jobs, create jobs, and ultimately, at the end of the day, his conclusion was it'll create more jobs. Artificial intelligence has an opportunity to change how we do so many things, and much of the debate for me can be bifurcated into automation, things go away, and augmentation. People make more money because production goes up, and you've argued that perhaps there's a way for us to see a reduction in interest rates because of that increase in productivity. One of the things standing in the way of that conversation is what's happening in South Carolina, where data centers are meeting real headwinds. New York has basically banned them. We have a moratorium in parts of South Carolina because of issues like electricity bills, water use, aesthetics. So getting to the future that we're talking about, and frankly, beating China in this AI race might come down to something as important as electricity bills and water usage, which could prevent us from having a serious conversation about productivity gains. Thoughts?
I can't think, Mr. Chairman, of a more consequential change to the U.S. and global economy in my adult lifetime than the surge of investment and the potential in around AI. That's part of the reason why one of my task forces is to focus on what's the effect of this general purpose technology on both parts of the Fed's mandate, on ensuring stable prices, but also on full employment. You gave us both parts of that.
Yep.
We don't have any legislative orphans at the Fed. There's no disfavored part. I would say it is a huge opportunity, but it's not without challenges. I'll make two other brief points. I think the United States is extremely well positioned to be at the cutting edge and extract more productivity, which should be good for U.S. companies and U.S. workers, than any other country in the world. Any other country would exchange positions with us in a moment. Second thing is, I do want to make it clear that in the near term, I think this investment is probably quite good for jobs as we're building out the infrastructure. And over the long term, my best guess is that this will improve American productivity and will improve the real wages and will help us on full employment. But between the short term and the long term, it can have a disruptive effect. And we're attuned to that. And that's part of the reason why I wanted to shed some new light on it with some outsiders.
My time is up, but I will submit one question for the record around the issue of indexing our regulatory thresholds. We've seen so much growth in the since 2019 that our institutions might need to see a little recalibration on the thresholds that we have put upon them. Ranking Member Warren.
Thank you, Mr. Chairman. So the Federal Reserve has long been plagued by a culture of corruption and coziness with Wall Street. Over the last 5 years, at least 6 senior Fed officials have been implicated in serious ethics scandals related to personal stock trading and self-dealing. But instead of trying to repair this broken culture, I'm concerned that you seem to be embracing it. At the time of your nomination, you owned more than $100 million worth of shares in private investment vehicles called the Juggernaut Funds and THSDFS LLC. And you refused to disclose the underlying assets to the Senate and to the public. You say now that you've sold those shares. In other words, somebody wrote you a check for more than $100 million days before you entered office. Chair Walsh, who wrote that check?
Senator Warren, this is a discussion you and I had in the public square 7 weeks ago, and I'm thrilled to tell you that I have fully honored the obligations I had under the agreement I had with the Office of Government Ethics.
Yeah, I'm
there is
glad you
continued
did,
disclosure, which I'm happy to make as consistent with the agreement.
I asked you a very specific question. Who gave you $100 million right before you were sworn in? Was it a billionaire who has business with the Fed? Was it Stanley Druckenmiller, who's made billions of dollars betting on what the Fed does? Or was it a different billionaire? Who gave you the money?
I will fully comply with the Office of Government Ethics.
That's not an answer.
Well, it is an answer, actually, Senator, because there are obligations, and I will satisfy them completely.
$100 million that you got just before you were sworn in, and you won't tell the American people where it came from. Let's go to another incident. As you know, the Fed imposes a blackout period where senior Fed officials are prohibited from talking about economic issues with outsiders. The idea is to, quote, reinforce the public's confidence in the transparency and integrity of the monetary policy process. In other words, no one gets some special insider information from the Fed. But shortly after your first FOMC meeting as chair, right in the middle of the blackout period, the Fed's vice chair for supervision, Michelle Bowman, was reportedly the featured guest at a secret dinner hosted by Bank of America for its hedge fund and Wall Street clients. At this closed-door dinner, she reportedly spoke about both monetary policy topics and regulatory policy. Now, I've called on the Inspector General to review her conduct, but you're the guy in charge. As chair, you set the tone on culture. Did Vice Chair Bowman provide any non-public information to the attendees at that secret dinner or discuss any regulatory policy matters that are subject to open comment periods?
Senator, I agree with one of the premises of your question, which is I do set the culture.
Good.
After my very first week at the Fed, I sent a letter to the 21,000 people at the Fed outlining our culture.
I appreciate that, but we have very limited time and a very strict chairman. So can you just answer the question about the vice chair and her secret meeting?
Sure, I'm happy to the extent I can share it with you. The vice chair has been an excellent colleague in my first 7 weeks. I'm aware of the letter you sent to the Inspector General. Out of an enormous respect for him, his investigation, what he chooses to do with it, I'm going to leave to him to do without trying to micromanage that.
So you
and I'd be interested in the judgments that he comes to.
So you will support his investigation. Have you made your own investigation? Did you ask her if she spoke at a secret meeting during the blackout period?
I agree with the suggestion that the Inspector General is an independent actor, and I'd be very interested in his decision.
You just said you're the guy in charge. Did you ask her about the secret meeting that took place? Did you ask her?
I can answer a simple question, which is I wasn't at the meeting. I don't know the facts.
No one
but I'd be
you
very
were.
interested in the fact-finding being done by an independent Inspector General.
Did you care enough to ask, how can you be chair and not ask your own vice chair whether or not she violated the blackout period, violated the law?
I think it'd be inappropriate for me to prejudge facts that are being discovered by an independent actor.
I don't know how you prejudge them if you don't ask.
Well, I don't know how to prejudge them if I wasn't in the attendance of a meeting.
Did you ask?
She's been an excellent colleague.
Did you ask?
I've asked her a lot of things about supervision and regulation
Yeah,
because we've been busy doing a lot of real work over the last 7 weeks.
I gotta say, I'm gonna take the same time you did. I just gotta say.
You hope so.
The tone that you are setting is one that seems to invite corruption, and that's going to be a real problem.
We've had 7 weeks, Senator Warren, and we've set a tone of performance, accountability, responsibility, and integrity.
Senator Rounds has the floor.
Thank you, Mr. Chairman. Mr. Warsh, welcome to your first meeting.
Thank you, Senator.
Let me give you an opportunity. I think I've got some questions that I think are important with regard to the Basel III and what we're going to do with it. But before we get into that, I think you've been basically harassed a little bit in terms of making accusations to you. Let me give you just a minute to perhaps respond in a just straightforward manner to some of this stuff. Anybody give you $100 million?
No, Senator. No one did any such thing.
Possible that you may have had assets that were sold based upon an agreement that you had as you became the nominee for the chairmanship?
Yes, I had earned assets over a long period of time and went over and above any ethics agreements and have sold or in the process of selling, have nearly completely sold everything that I had earned during that period and have rolled those into the equivalent of cash and T-bills.
So basically away from investments based upon the market and back to treasuries.
Yes, exactly right. I thought that was the prudent thing to do given the responsibilities and the importance of setting the tone at the top. Culture is the big driver of a lot of things, and in my first 7 weeks, Senator, we're doing our very best in the best of the Fed's traditions to get the culture right, to get the strategy right, and to get policy right. And if we can do those things, all of which are to the left of the decimal point, might not be of such great interest to people that are trading on Wall Street, then I think the decisions we make to the right of the decimal point can be better, so we can do a better job of fulfilling the mandate you gave us.
Yeah, the ranking member had asked a question with regard to another member on the committee, Nikki Bowman, and you indicated that if there was an accusation being made as to an inappropriate meeting, that if the Inspector General was doing it, that you were going to be hands off on it. It seems to me that that's pretty appropriate, because if you would have gotten involved in it, the accusation from some members on this committee would have been that you were trying to influence it.
Yes.
Can you talk a little bit about the logic? Am I on the right track with regard to the reasoning that you have for allowing the Inspector General to do the job that they were asked to do in the first place by members on this committee?
Yes, Senator, you're exactly on the right track. I'll just say more broadly that my fellow governors, my Reserve Bank presidents, they've received me incredibly warmly. I admit that I show up with a lot of ideas for reform in monetary policy and supervision and regulation and payments. I've only been there a short while, for 7 weeks, but instead of an institution acting inert, what I've found is my colleagues are really open-minded to change. What I found is we're going to have a good family fight. I'm not imposing ideas. That's part of the idea of the task forces the chairman referenced. But we're going to try to be better at our jobs, fulfill our mission, be accountable, be responsible, and do it all with the utmost integrity. That's my intention. We're early into this. I don't want to prejudge outcomes. We made a lot of progress in a short period of time, and frankly, I'm proud of it.
I like the idea that you're putting together working groups. I think that will give an opportunity for a fresh look at a lot of things going on. As I shared with you in a phone call earlier, it's not a matter of being necessarily vindictive or angry with previous chairs or previous members. It's a matter of making things better for the American people, and that's really what we ought to be talking about today. So let me just, in the minute and 14 seconds that I've got left on mine, let me talk a little bit about Basel III in particular. I think you and Vice Chairman Bowman and the respective financial regulators, I think you've done a good job in terms of your roles with regard to the Basel III reproposal that was issued this March. The 2023 proposal would have substantially increased common equity capital requirements for Category 1 and Category 2 banks by approximately 19%, failing to strike a balance between maintaining resiliency of our banking system and doing so without hampering lending. I think this is a really critical item, and next to what artificial intelligence is going to do in terms of our productivity, I think it's one of the biggest issues out there. With the June 18th comment deadline now behind us, are there any other categories of feedback that you're weighing more heavily than others, such as the adjustments to leverage ratios or anything along that line? And if I could, is there going to be a go-live date this year sometime? Any idea when you might actually be able to talk about when this thing is going to go public for us?
Senator, well, thank you for your question on supervision regulation. As I mentioned before, I've shown up with a lot of ideas for reform, not just in monetary policy, but in supervision and regulation too. When I was before this committee some 20 years ago, there was a debate about what the Basel process should be. Boy, we should get to the bottom of that 20 years later, and we should end up with a set of reforms in the United States that makes our financial system and our banks safer, sounder, and more competitive. It is that competition which provides better and more agile credit to the real economy. The Basel endgame, Senator, is not America's endgame. I am happy to work with international regulators to try to find common views, but we're going to do the right thing for the U.S. economy. As you mentioned, we're out for public comment. I'll be very interested in the comments before we go final with the proposed final rule.
Let me just say, this is already off to a good start. But we're going to stay around 5 minutes, period. Thank y'all. Senator Reid, the floor is yours.
Thank you, Mr. Chairman. Chairman Walsh, I want to see if I put a cap on this discussion between Senator Warren and Senator Rounds. When will you disclose who brought your assets? When?
I believe there's periodic requirements under the ethics laws, and I'll fully comply with them. I think the next reporting requirement is at some point in the next quarter or so.
And you will fully disclose who you sold your assets to?
I'll fully comply with the law and the ethics agreement.